If you paid attention to the news or stock market recently, you might have heard a lot about AMC and the infinite money glitch, aka the short and gamma squeeze.
At this point, it should be obvious that if you try to short AMC, you're going to end up just like the guys who shorted it in January. You're an idiot.
Because short sellers aren't going after retail investors. They're going after bad companies. I mean, it's the most absurd thing I've ever heard.
If you don't understand what's happening, why, or how, then you've come to the right place. I'm gonna break everything down for you in this video because, my friends, we are in the middle of history. The last memory of AMC you've had was probably more than a year ago, where you might recall paying $34.21 for a medium popcorn and a box of Whoppers on the side. Since then, quite a few things have changed. Due to illness in 2020, just going to the movie theaters was probably the last thing on people's mind, being in a crowded room and trying to get little bits of corn out of your teeth. This led to a lot of movie theater chains being hit very hard financially to the brink of bankruptcy. And unfortunately, the largest movie theater chain in the world, AMC, was no exception to this. All the way back in March 2020, AMC announced that they were closing all their locations in the US and were nearly pushed to bankruptcy last year. However, thanks to a $917 million cash infusion in January 2021, AMC was able to avoid all of that. So what's going on right now? Well, ladies and gentlemen, let's set the stage. After increasing fears of bankruptcy, AMC hit an all-time low of $1.91 in January 2021, and then in only a few months to June 2021, AMC shot all the way up to an all-time high of $72.62, which is more than a 3,000% jump. Why did this happen and what's expected to happen next? Firstly, AMC had a large percentage of its float shares sold short, which made it one of the most shorted stocks in the US market. Back in January 2021, AMC was the third most shorted stock in the entire US market under the infamous GameStop and Dillard's. Now let's break the sentence down a little further. Float shares are the number of shares that are available for trading of a particular stock, so when you go to your brokerage app and buy and sell, you're doing it with float shares. So when a large percentage of a stock's float shares are shorted, well, that basically means that investors or Wall Street despises the stock and was hoping to profit from the company failing and the stock price tanking. Now the mechanics behind shorting a stock is a bit complex, so let me start with a simple example. Let's say your friend David has a ball that's worth $10, so you go to David, you ask to borrow that ball, and promise to give it back to him in 10 days. You then go ahead and sell that same ball to John for $10 because you're betting that in about 10 days, the price of the ball will drop and that you'll be able to buy that ball back for a cheaper price. So in 10 days, you find out that you were right, so you buy the ball back for $4 and then return the same ball back to David. And from that, you've just profited $6. Now imagine if the ball in this case is AMC stock. What Wall Street and major hedge funds did was short AMC. They borrowed AMC stock and sold it with the expectation of the stock price falling and then subsequently going out and buying AMC stock back and then profit off the backs of a struggling company and thousands of people losing their jobs. But what if they were wrong? What if, for example, instead of AMC or the ball falling in value, actually does the opposite instead and instead goes up in value? So if the value of the ball goes up to $50, then you who shorted the ball would be forced to buy the ball back for $50 before returning it to David. So you just lost $40. If the ball went up to $1,000, then you lost $990. If the value of the ball continues to go up, well, then you just keep on losing money because theoretically shorting something brings about infinite risk because there's no ceiling to how high the value of something can go, especially when it comes to a stock scenario as intricate as AMC, which we'll break down even further. One important thing to note is that when someone shorts a stock, in addition to being exposed to infinite risk, a short seller also has to pay interest when they borrow the shares. So imagine you're getting a loan, you have to pay interest for the duration of that loan. So it costs hedge funds, in this case, interest and money every single day to hold their short position. So that means if the stock price goes up, when they expect it to go down, they're still paying interest before they exit their position. So we set the stage, the actors took their position, and now let's throw in an unexpected and illegal plot twist. And this is called naked shorts, which takes the concept of shorts that we just talked about to a whole nother level. Now, whether AMC actually has naked shorts is not something we can confirm with 110% certainty at this moment because of just how opaque the entire market data is, but there is increasing evidence based off people doing massive due diligence in this. If you look at mainstream media, they won't say anything about this. They won't say any concept of naked short. They're very careful to avoid this topic because some speculate that Wall Street is exerting their influence on what mainstream media is allowed to say. But a news anchor might have slipped up the other day. Here, listen to this clip very closely.
There are a lot of short sellers out there that have been borrowing stock they didn't have. In other words, yes, I think there are dynamics where retail investors can get caught.
Did you catch it? Let me play it again.
There are dynamics
shorts,
where
yeah.
retail...
She said the word naked shorts, which might have been a no-no because notice her reaction right afterwards.
But it's really...
She was completely shooketh, as if she said something that she wasn't supposed to say, or she saw someone wearing shorts while naked. Naked shorting is essentially shorting, which is completely illegal, but it involves shorting without actually having the actual shares on hand, which is illegal. It's the equivalent to you spending shares that you don't own, and it's not some massive conspiracy concept either. If you recall, this has happened in the past with the situation from GameStop. With GameStop, we actually saw short interest hundreds of % over the float shares, which indicated that more than the available number of shares were shorted. A naked shorting is terrible for the market environment because naked short selling causes the number of shares in the market to increase, which sends the share price to drop because more shares equal less value. So you might be questioning, how can they short more shares than there are shares available? Well, let's say AMC issued 300 shares of their stock and Fund A wants to short AMC stock, so they borrow 200 AMC shares and then they go ahead and sell them to Institution A. So let's say Institution A then wants to lend their stock out, so here comes their buddy Fund B, who also wants to short AMC stock. So Institution A lends Fund B 200 AMC shares, and now Fund B wants to go out and sell 200 AMC shares to Institution B. This means that there are now 400 AMC shares sold short out of only 300 AMC shares available. In reality, it's a little bit more complex, but you get the gist on how this continuous borrowing selling of non-existent shares, which are called synthetic or phantom shares, are created. Now, ladies and gentlemen, is when the whole AMC saga begins and it all gets really interesting. This is when the rest of the actors come on stage. Reddit, Wall Street Bet, and the entire ape army, which is just a term for anyone who is hodling at least one AMC share. So let's say a few people were bullish on AMC stock way back when and was feeling really good about it because they think it's a good recovery stock play, it has a lot of potential as a company, or they see it as a heavily shorted stock. So a Reddit user called Turn That Like Button Into a Beautiful, Beautiful Blue posts our research on Reddit saying AMC is a fantastic opportunity because of X, Y, and Z. And people start to see fantastic news on AMC such as it just escaped bankruptcy, they're giving away free popcorn to shareholders, movie attendance is returning, the economy is reopening, and so on and so forth. So the ape army and other retail traders decide to purchase thousands and thousands of AMC shares, causing the share price to go up, which makes it a perfect setup for this concept called the short squeeze. Remember, if the value of a shorted stock goes up, shorts are losing money because they're borrowing the shares and are paying interest. So the more the stock price increases, the more the shorts are getting squeezed out of their position and they'll need to buy the shares back at a higher price, leading them to lose money. And with such a large amount of short positions and potentially naked shorts, there's going to be a massive amount of buying pressure when the shorters need to cover their position. This buying pressure further increases the stock price, which pressures other shorts to exit their position by buying back the stock, leading the stock price to go up even more. But remember, it is possible that more than the number of available shares are shorted, meaning that if the ape army refuses to sell their shares to the shorts, then AMC stock price can theoretically keep going up to the moon. But that's not all. There's another buying pressure that you need to know about in just a bit. So what's next and how high will AMC go? Before I tell you the specific number, let's actually check out our history book for some clues for the earliest use of the term infinity squeeze. Back in 2008, during one of the worst financial crises, Volkswagen was increasingly viewed as a bankruptcy candidate and therefore was heavily shorted by Wall Street. Long story short, the short squeeze happened, which sent the stock price flying from $72 all the way to $912, over a 1,000% increase that led to hedge funds losing $30 billion. But will AMC stock go up another 1,000% or more? This is when we introduce another buying pressure called the gamma squeeze, which is when you hug your grandma really tight. Oh, wrong definition? I thought that said grandma squeeze. Okay. Let's break down gamma squeeze. Let's say your friend Mike thinks that AMC stock will go up, so he goes out and buys call options, which is a bet that the stock price will go up above a certain price by a certain date. And this thing called the market maker sells the call options to Mike. Now the market maker wants to hedge their position, or at least limit their risk, so what they do is they go out and buy AMC shares at the current price. If there's a lot of Mikes in the world who wants to buy a lot of call options from the market maker, then the market maker will continue to buy more and more AMC shares, in order to hedge their risk. And in effect will increase the stock price, would in theory incentivize more and more people to buy call options because they continuously think that AMC share is going to go up, leading the market maker to continue to hedge their risk and buy more AMC shares at the current price. Again, this is an oversimplified example. There are other factors like call options expiring in the money versus out the money, which causes them to cover, but you get the point of what a gamma squeeze is. There's also another group of buying pressure called the FOMO buyers, or the fear of missing out, who when and if they see the gamma squeeze and short squeeze come into play and AMC going to the moon, they'll want to get a piece of the pie and buy some shares, further fueling the buying pressure and increasing the price. So exactly how high will the price increase? Well, with my latest calculation, taking the percent short interest multiplied by the volume traded the past few months divided by the Buick law and forecasting for the accelerated growth of nano Ethereum intervals, the stock price can go up to $271,451, give or take a few dollars. No, but seriously, the real answer is that no one knows, because the reality is AMC is no longer about the fundamentals of the company, and this is a much bigger thing now. It's an entire movement. It's a David versus Goliath story that depends on what kind of materials the ape army hands are made out of, paper or diamond, and ultimately how long they're willing to hold if the stock price goes up. So if you're an ape with diamond hands, go ahead and comment some diamond emojis. But regardless, whether you believe in the fundamentals of AMC or the entire ape movement, you have to admit that this will be in our history textbook, where the 99% takes on the 1%. And with the recovering illness, reopening economy, people with money who want to spend it, and the intrinsic love people have with AMC again, it does seem like AMC could be on the path to recovery as a company. But I'd love to hear what you think about the entire saga. If you stayed until the end, you guys are the real ones. Comment some banana emojis below so I know you guys are the real ones.